Hi, very good evening, ladies and gentlemen. Thank you so much for joining us on time for today's webinar. My name is Jinkit and I'll be your speaker for today. So for now, let us wait for another 2 minutes, for more of our friends to join us to this session. Then we will begin proper at 7:02. In the meantime, you may grab some snacks, a water, and I'll speak to you shortly in 2 minutes. Hi, a very good evening, ladies and gentlemen. Once again, thank you so much for joining us at our session today with the title of A Beginner's Guide to Technical Analysis. My name is Junkit from Phillip Nova. So today, right, I'm actually not feeling my best. So later, I do seek your forgiveness if I have to take like a quick, like 10, 15 seconds of break, just to drink water because I'm currently suffering from a bad throat. But with that aside, let us jump straight into the disclaimer for today's session. Whatever that we cover here today, it is meant to be educational. That means you should not take this as any form of investment advice, because the topic that we're going to talk about today is relating to leverage product, and it's an instrument. If you don't know how to utilize it, it could potentially pose a high risk for you. So and we are sharing this without taking into consideration your personal investment objectives, financial situation, and risk appetite. So we do ask that you do your own research and do your own due diligence before engaging in any trades. And today, what we hope to deliver to you is really just educational material for you to have a better understanding on what technical analysis is about. For those of you who may not be aware of who we are yet, Phillip Nova, okay, we were formerly known as Phillip Futures, and actually we've been around the market for a pretty long time, from 1983 since then, okay, and we are actually one of the founding clearing members of the Singapore Derivatives Trading (SGXDT), and since then, since 1983, we've grown to become one of the region's top brokerages for trading of stocks, CFD, FX, futures, commodities, and more. So in short, Philip Nova today, we are a multi-asset broker offering you access to trading access to various kind of products, from exchange traded products to OTC products, which is primarily the focus of today's session. And a little bit about myself. I am the senior strategist at Philip Nova. So my main expertise is in the Department of Forex, and I do specialize in the business development efforts of the products and the platform. I actively engage in events like this to to speak to our training community, and a webinar like this is just part of what I do. And besides that, we also do hold a lot of physical seminars and events. So next time, we do hope to see you in person at some of our physical events in our office. And besides that, I do have the pleasure to every now and then publish my market views on various reputable news publications, sites like the Business Times, 联合早报, Money FM 89.3, and also Channel News Asia. Okay, and recently I've cleared all of my exams for the Chartered Market Technician (CMT) exams. So essentially, this is a three-level examination that focuses purely on technical analysis. Okay, and today just so happened that I'm also speaking to you about technical analysis. Right. So after going through this curriculum and also my many years in this financial industry, I have condensed for you just in 1 hour of session to tell you what are the important things that you should take a look at when it comes to technical analysis. Okay, so before I move on to the next slide, just to give a brief overview, when you place a trade or when anybody wants to place a trade, there has to be some form of basis of that there has got to be some form of basis before you make your judgment or your decision to place a trade. Okay, so is it based on fundamental factors, like let's say if you're looking at the interest rate environment of a certain country and how it's going to affect the currencies? Okay, or let's say if you're looking to trade a company shares, right, are you evaluating your trading decision based on the future earning potential of the company, etc., etc., etc.? Okay, so those are what we call fundamental analysis. On the other hand, what we have is technical analysis, which is the study of price, okay, um, which is the study of historical price movements, okay, and how, so based on the historical price movements, and we try to predict the future movements of the market. Okay, so essentially we are looking purely at the market behavior. Okay, so technical analysis, you may, for those of you who may have started to dabble into TA, you may find a lot of information online. There's different kind of candlestick patterns, there's different kind of like indicators, there's different kind of concepts out there. But what I hope to achieve in today's session is to boil down to you what is the framework, or rather what is the thought process you should have, when approaching TA using various kind of concept. Okay, in other words, when I first started learning TA from online, I feel it's very fragmented. Like you learn about certain things on a certain website, you learn about certain things from a certain book. It's all over the place. But essentially, how to make all these concepts and knowledge work for you, I think is the ability to piece them together and to look at the big picture, to be able to connect the dots. Okay, so technical analysis, at the end of the day, what we hope to achieve is, like what I'm sharing on the screen right here, to be able to identify the start of a trend early. Okay, secondly, enter a trade at the early stages of a trend. And thirdly, exit the trade when you see signs that the trend is going to end, or rather reverse. Okay, so first of all, look for the trend, identify the start of a trend early, enter a trade at the early stages of the trend. Thirdly, exit the trade when you see the trend that you were looking for is no longer going to continue, it's going to reverse. Okay, and also very important, the best time to trade the market is actually when the market is trending. Okay, choppy markets should be avoided. So let's say if you're looking, if any one of you here are actually looking at the FX market recently, I think it's been pretty choppy. Let's say if you're looking at the daily time frame, you can see that the dollar index has been choppy. It's just been trading in a range bound tight range. So let's say if you're looking to enter into any short trade or long trade, chances are your stop losses would be hit pretty quickly, because it's not going anywhere. It's just going up, down, up, down, up, down. It's whipsaw. Okay, so the best time for you to trade is actually when there's a clear trend on where the prices are going and you ride on that trend. Okay, choppy markets should be avoided. And even for gold, if you look at the daily time frame for gold, it's been consolidating, so not very nice to trade. And in this session, I'm gonna share with you what are the basic methods to gauge the trend, okay, followed by some of the confirmation or entry and exit signals that you could adopt to incorporate into your trading strategy. Okay, so speaking of TA concepts, there are a lot of concepts out there, but they are mainly categorized under two broad studies. So first of all is what we call the Western technical analysis, and the second one is what they call the Japanese technical analysis. So two different kind of concepts. You may have learned them separately. So let's talk about Western technical analysis techniques first. So these would include concepts like support and resistance, chart patterns, technical indicators, and volume analysis. Okay, so it's more like looking at lines, chart patterns, RSI, MACD, all that. So those would belong to the Western methodology of TA. On the Eastern side, on the Japanese side, what they are most known is the Japanese candlesticks, which are invented by some of the rice traders back in the 18th century, and today they are still very much popular among the traders. So the question is, which method of TA is better? Okay, so the answer is actually to use either one of them. It shouldn't be seen as mutually exclusive. It's not like either or kind of thing. In my From my experience and based on my personal opinion, I think that they are the most powerful when you use them together, right? The Western TA is great for helping you to identify the overall trend of the market, support or resistance zone, and also confirmation via indicators. Okay, in short, Western TA is good for helping you to look at a big picture. Japanese TA, on the other hand, those Japanese candlesticks, they are good at helping you to pinpoint perhaps entry and exit timing based on the price action psychology. So what I would think of candlestick patterns, they are more for like a more micro kind of time frame. They're more shorter term kind of signal. So you want to incorporate the larger time frame with the TA, the overall trend. And when you are actually looking to place a trade, then you can pay attention to the candlestick pattern as a confirmation, as a confluence to your Western TA analysis. So the first lesson right here today, you may have heard of this, from your friends. In trading, the trend is your friend. All right. It may sound like a cliche, but I'm telling you, the trend is really your friend. And when you see your friend, I think it's a good time to consider engaging. But when you don't see your friend, when you don't see a trend, okay, it's oftentimes wiser to stay on the sidelines because remember, in trading, the decision is often not to buy or to sell. Okay, there's a third option, which is very important, which is the question of should you even trade at all? Okay, so once again, it's not buy or sell, it's it's to trade or not to trade. Okay, if you've deemed that it's a time where you should trade, then you think of buy or sell. Okay, otherwise, if you don't see any trend, it's better to stay on the sidelines and just enjoy your coffee. You just don't have to trade. To identify the trend. Okay, so for the next few slides, I'm going to go through a few simple ways for us to identify a trend. Okay, so we start with just a few methods. The first one is, of course, to draw lines. Okay, so there's a few types of trend. The first trend is, of course, an uptrend. And you are able to identify an uptrend by connecting a series of high lows. So by textbook definition, if you are able to connect at least three high lows to form a trend line, there you have an uptrend. And that line that you have managed to draw, and that would serve as a support line. Okay. On the other hand, there's also downtrend, and a downtrend is identified if you are able to connect at least three lower highs that you can form a trend line with. Okay, so I've covered uptrend, I've covered downtrend. And in a downtrend, the line that you're able to draw connecting all the lower highs, that would form your resistance line. And also, there is something called the sideways trend, which is a time where the market is not either going up or going down. It's just staying in a tight zone, consolidating. Okay, and if you're able to connect at least three highs and three lows, you have formed a sideways channel. Okay, there's uptrend, there's downtrend, and there's a sideways trend. Okay, we are clear on that. And at this time, let's just elaborate a little bit more about the concept of support and resistance. Okay, some people may think of it as a supply or demand zone, but they essentially mean the same thing. So looking at the photo here, right, on my screen, if you're able to connect a series of highs, okay, that is actually your resistance line, whereby when prices, upon hitting it, it tend to retrace to lower. Okay, just like Bitcoin back in the days, where 100K was a key psychological resistance for Bitcoin. So it did test a few times. Okay, whenever it rises to 100K, sellers will come in, and then when it rises to 100K again, sellers will come in to take profit, right? But after they managed to pierce through the 100K level, the previous resistance line will then turn into a support line. Okay, so it has turned into a ceiling to a floor. So you can think of resistance as like just an imaginary ceiling that prices just cannot go above. And whenever prices reach there, the selling pressure would come in, sending the price lower. And on the other hand, you also have the support, which you can think of it like an imaginary floor that the prices simply just cannot go below it. And then whenever prices dips to that level, most market participants would think that, oh, this is a fair price for me to get, and people would come in with the money to buy, okay, and with enough demand at this price level, the price would eventually increase. So it's a matter of supply and demand. Okay, a certain level, people think that's going to go down, people come in to sell, it comes down. And in terms of support, people think that prices is going to rebound from here. Therefore, it's somehow like a self-fulfilling prophecy whereby everybody buys and it eventually goes up and it comes true. So the question now is, how do you identify this support and resistance line? Of course, the very straightforward method is for you to practice. Like, it involves a lot of practice, a lot of chart time. But the good news that I can bring to you today is I can teach you how to easily identify support and resistance line using Phillip MetaTrader 5 platform, which is a platform that we offer to our clients to perform their trades in FX and CFD. So how do you do this? Okay, so on our Phillip MetaTrader 5, you can download this additional tool that is called the Trading Central Analyst View. So the download process is just, it takes like less than 2 minutes. Okay, after you've downloaded it, you are able to launch these tools on all of your charts. And upon launching it on all of your charts, as you can see from my screen here, it automatically plots for you all the support and resistance line. So whatever line that is above the current price that you're seeing right here, those are your resistance line. Okay, and whatever price that is below, those are the support line. And besides the lines, okay, besides the key interest areas, they also give you a directional bias on what they think, what Trading Central think is the bias. Is it more of a bullish bias or is it more of a bearish bias? Okay, and if you observe, right, some of these lines that they draw, it really connects some of the highs. It connects some of the highs, it touches the high, and some it is very near to the low, to the swing low areas. Okay, and right now I can jump over to my MT5 to show you briefly how you can launch this chart, how you can launch this feature. So the download button, or rather the places to download this, is on our website. You are able to download that, or after you sign up for an MT5 account, in the welcome email, you receive quite a few emails to help you set up the platform. In one of those emails, you'll receive an instruction to download this tool. Okay, once again, download procedure is very simple, and within 2 to 3 minutes, you'll be up and running. So what I have here is our Phillip MetaTrader 5 platform with this Trading Central tool already downloaded. Okay, in the interest of time, I'm not going to go through the detailed walkthrough of this platform, because today the main point is to give you a context on what TA is about and how to crystallize some of these techniques for you to do your trades. Okay, so I'm just going to quickly demonstrate to you what this tool can do for you in order for you to identify all this support and resistance conveniently. Okay, so you notice what I just did, right? I simply drag and drop this tool into the platform, and you see here, I don't even need to have any practice in order to draw the support and resistance line. This tool would be able to help me draw out all the line already. So let's say if you're looking at the cursor that I'm pointing right now, this is a swing low. Okay, so you can see this like a floor. Okay, after it bounces above, after it breaches below, this becomes a ceiling for a moment, and after that it bounces back up again. And you see further down the road, when prices react to this same floor again, it tends to bounce. Like the past low points or high points tend to have an effect on the future price movements as well. So those are what we call the support and resistance line. So let's say if you want to look at maybe like other contracts like euro dollar, okay, I simply need to drop to this chart, right, or rather dollar yen. Okay, okay, and you can see the lines will all be drawn here. Okay, and then depending on different time frame, the lines will be redrawn as well, and you can zoom in to actually look at this support and resistance line very clearly without having you to plot it themselves. And there is also a few commentary down here, but of course, why you're seeing the words are so small, because I'm presenting currently on a TV screen. Okay, so the screen is rather large and the words have been compressed. So let's say if you're trading on your PC, the words would have been of a normal font size. Okay, and then let me go back to my slide here. And also just a point, just a note when you're looking at all these trend lines and support and resistance. So generally, the horizontal support and resistance line tend to be more reliable than the support or resistance line that are diagonal. Like let's say those upward sloping trend lines or those downward sloping trend lines that I drew earlier, as compared to a horizontal lines like what you're seeing on the screen, this will tend to be more reliable. Okay, so with this tool, you're able to launch all these without having to screen through all the high points and low points to draw your own ones. And let's say if you're really into, trying to master the craft of identifying these levels, you can do your own analysis. But after that, it's always helpful to just launch this, just try to validate to see if the professionals from Trading Central agree with what you have analyzed. Okay, so the section just now was about how to identify the trend using trend lines. Okay, it could be upward sloping, downward sloping, and horizontal trend lines just by visual inspection. Okay, what I've covered so far is just by visual inspection. The next section is going to talk to you about how you can use technical indicators to objectively show you if the price is on an uptrend or a downtrend. Introducing my favorite technical indicator, it is called the moving average. So what moving average is basically a line that smoothens out the past price movements. So let's say on the screen here, there's a few EMA lines. The top line, the one in blue color, is 20 EMA, 20 exponential moving average. What it does is that it smoothens out the price of the past 20 days. And to the very bottom, in the 200 EMA, it smoothens out the price of the past 200 days. Okay, because day to day, the price movement, it can fluctuate, right? It can be volatile, it can go up, go down. So with this EMA, it can tell you objectively where the price is going. Is it on an uptrend or is it on a downtrend? But if you ask me why 20, 50, 100, 200 EMA, these are just the ballpark figures that the technical analysts normally use. Okay, but you are free to experiment with your own set of parameters. But generally, these are the parameters that most traders would use. Okay, so like I mentioned earlier, moving average is an indicator that helps you smooth out the price movement by creating a constantly updated average price. Okay, so this smoothing effect, right, it makes it easier for you to identify the direction of a trend by filtering out some of the noise from random short-term fluctuations. And if you attempt to launch this indicator to your platform, right, you'll be given two choices. Do you want it to be a simple moving average, or do you want it to be an exponential moving average? And I would advise to go for exponential moving average because it places more importance to the recent price movements. Okay, I am not going to go too technical into this. In short, the EMA is more responsive to the current market conditions, whereas the SMA could be a bit lagging. Okay, so use EMA instead of SMA. So let's say you've already launched two of these EMA. The standard ones I always love to use is either the 20 EMA and the 50 EMA. So I use them together. So first way on how to read this, let's say if the prices is above the EMA lines, it tends to validate that it is on an uptrend, like what you see here on the left side of the screen. Prices are consistently finding support above the EMA lines on an uptrend. On a downtrend, however, you can see that the prices are clearly kept below the EMA lines. Okay, so without having to draw the lines yourself, by looking at this indicator, you are objectively told if the prices is in an uptrend or in a downtrend. And whenever you place a trade, you want to place your trade in accordance to the trend that is currently happening. Okay, like the saying goes, like it's the chances of you making money by going long in a bull market is higher than the chances of you making money by going short on a bull market. Okay, so in short, the trend is your friend, follow the trend. Okay, this is the first method that you can use moving averages to determine the trend. The second method is when you can observe the moment when the two EMA crosses with each other. Okay, so let's say in an uptrend, right, the shorter term EMA tends to be above the longer term EMA. Okay, like the first part here, the 20 EMA is higher than the 50 EMA. So this is typical in an uptrend. And when you see that it is starting to reverse, That's what we call a bearish crossover. When the 20 EMA crosses below the 50 EMA, it's what we call a bearish crossover. And that is a signal to tell you that, oh, the tides may be changing. We may be changing to a downtrend from here on. Okay, and in this case, of course, I choose a good example to show you. It did turn into a downtrend. And after that, when it reverses to an uptrend again, you do see that the bullish crossover happens, whereby the shorter term EMA crosses above the longer term EMA. Okay, so bearish crossover and bullish crossover. The second way that you can utilize EMA in helping to determine the trend. Okay, so then you may be wondering, is this a perfect indicator? Do I just use this all the time? Okay, but of course, no indicator is perfect, no strategy is perfect. There's a pro and there's a con to it. So the pro of using a moving average is that it helps you to identify objectively if the trend is going up or down. It smoothens out the price fluctuation. And the third point right here, it is widely used as a support and resistance. Okay, so I'm not sure if you notice, let me rewind back, right? If you notice, after the prices cross below or above the EMAs, they tend to serve as a support line or resistance line. Okay, so looking at the right side of the screen right here, you see after it crosses below all this EMA, right, it is finding some kind of a resistance when it reaches these EMA lines. Okay, when it reaches, okay, resistance, it dumps again. When it goes up, it tests, dumps again, dumps again, dumps again, until it crosses. Then you see that it has now turned into a support zone. Okay, so this is also a very cool feature of the EMA. You can also use them to look for support and resistance zones. And this moving average, it is the best to be used in a trending market. Okay, disadvantage is that the EMA, or rather the moving averages, they are considered a lagging indicator, which means whatever that you're seeing now, it is based on the past price movements. And whatever you see is it's basically lagging. Okay, so the prices would have to reverse to a certain degree or for a certain time in order for the EMA to pick it up and to reverse and to adjust accordingly. And the second part, EMAs are less effective in sideways market. In short, I think you should avoid looking for EMA signals, or rather MA signals, during sideways market. And third, the crossover can be late. I think this is relating to the first point as well. Whenever you see a certain signal, so let's say back to this example, right? Just an example, someone could build a trading system, okay, a mechanical trading system based on a rule, right? So let's say they input into MT5 with the algo trading feature to say that, okay, I want to execute a sell order whenever the 20 EMA crosses below the 50 EMA. Okay, whenever 20 EMA cross below the 50 EMA, I want to place a short order, sell order. Okay, so after when that happens, the system would execute a sell trade for you. Okay, so that, of course, that is wonderful if the market is trending very nicely. Okay, and the system will help you to engage in long and short positions every time it crosses and changes trend. But in a real world scenario, after trending for some time, the market can go into consolidation. Okay, it can be trading sideways for some time, and this is when you will notice the EMA, they would actually be crossing each other very often. Okay, what that means is that, let's say if you're engaging in every trade, after you see a crossover, the chances are you'll be losing a lot of money, because the predicting power of the crossovers is just invalid during sideways market. So it is also very important to know if it's a trending market or consolidating market, and this is only best used when the market is trending clearly. Okay, so technical indicators, there are a lot of technical indicators, and what I'm sharing here with you is only one. It's only moving average, because I think this would gel in nicely with the message that I'm going to put forth to you today, which is following the trend and placing a trade according to trend. But at the same time, on your own time, you should also explore some other technical indicators like RSI, like MACD. So these are also other kind of indicators that would help you, give you more confirmation in your trades. But personally, I don't quite use them a lot. And just an example, okay, so indicators like RSI, they would tend to work better in a sideways market. And in a trending market, that a market is clearly going to one direction, they tend to be less effective. And also there are many ways to use them. But due to the time constraint for today, I would not be able to share that in depth with you. But I do encourage you to use your own time to go and study about it, because knowing the different kind of indicators, knowing the different kind of tools in technical analysis is like having a toolbox with more tools, right? By having a toolbox with more tools, then you, at different conditions of the market, you are able to use different tools, different indicators to apply. Okay, the next portion is a portion when I'm going to talk about chart patterns. And I'm going to start with this quote that says, "History never repeats itself, but it often rhymes." Okay, what we are doing in TA, we are not trying to predict the market, because nobody can predict the market. We try to see how market is behaving, okay, and based on how it has behaved in the past, we try to project what is going to come afterwards. Then we place a trade accordingly, is either to an upside or to a downside. But when it comes to trading, I think risk management is very important. This is not my topic today, but trading is never sure win. Like, nobody can predict the market, right? So it is a matter of, whenever you are right on a trade, you want to make more than the times when you are wrong. So let's say every time if I'm right on a trade, I want to be making, like, let's say $150. But whenever I'm wrong on a trade, I want to be losing like maybe $50. Okay, so that's what we call the risk reward ratio. So what I'm trying to say is that risk management is very important. What I'm showing you today here, chart patterns, these are only for you to know where to enter and exit. But the risk management, to set your stop loss, those are very important concepts that you also need to learn. Okay, and how does this gel to the previous section of my sharing? Okay, market has been, so let's say on a scenario where market has been moving in a clearly upwards direction. But so now you know the market is going up. But when do you engage in the market? When is a good time for you to enter into a long trade? Okay, here comes the chart patterns. There are a few types of chart patterns. The first chart pattern is what they call a reversal chart pattern, whereby after you see such chart patterns, right, it tends to mean that prices is going to reverse. Okay, so let's say after a uptrend, if you see things like a head and shoulders pattern here, if you see things like a double top pattern here, it tends to signal that it may reverse to the lower side. Okay, so we have head and shoulders, we also have inverse head and shoulders. It's like a mirror image of both. But what I'm encouraging you to explore more today is what we call the continuation pattern, which is a pattern that tends to signal a potential entry for you to engage in a trade according to the prevailing trend. Because I think we can all agree that the market never goes up in one straight line, or neither does it go down in one straight line. Let's say if there's a very bullish news that is causing the market to rise, it would rise, very steeply, but it never goes up in a straight line forever. There tends to be area or times of consolidation, whereby the buyers are just taking a breather. Market is just moving in a slightly sideways motion, okay, not continuing the uptrend, but consolidating in a sideways motion before they take off again. Okay, and these are what we call the continuation pattern that we want to take note of and try to engage when we see them happening. So some of the famous ones that I like is a falling wedge. The opposite of a falling wedge is a rising wedge. And then the rectangle, I'm not really helpful. Not really helpful. It's just here an example. But my favorite kind of trading setup, which I think offers a very good risk reward ratio, is the triangle pattern. So you see here the triangle pattern, whereby if you connect a series of highs, and lows, right, you get like a converging line. Okay, you get like a converging line. So I would say the wedge patterns and the pennant patterns, they are very useful trade signals, or rather useful chart patterns. Okay, and the context of the direction of all these chart patterns, right? You must look at the trend that comes before the chart pattern. Okay, so if you see the top three patterns here, these are all bullish reversal. So you see that the prices has been coming on a straight line. Prices has been coming on a straight line. okay, and you want to wait for the prices to consolidate in a tight range, okay, whenever it gets like it goes down, goes up, whenever it gets narrower and narrower and narrower, it will reach the tip of the triangle, which is what we call the apex. And this is the time especially that you need to pay attention to it, because a breakout may very well happen. Okay, it's either to the downside or to the upside. And like I said earlier, risk management is very important. So for an example, like a bullish pennant, right, a triangle, you want to enter into a long trade after the breakout of the upper line, okay? And then your stop loss is to be set below the lower line, okay? And how you measure your target is by taking the uptrend that has been happening strongly before that. You draw a line, you measure how far this has gone, you plot it from the point of entry. That shall be your target point. Okay, so here's an example of a symmetrical triangle. After a strong uptrend, up, prices will consolidate again. It will consolidate. Okay, so after you see the consolidation, right, when it gets narrower and narrower, this means that the prices will tend to break out from here. And whenever it breaks out, the momentum tends to be pretty high. Okay, and from what you see here, the risk reward ratio for this trade, this setup, is about 1 to 4.6. For one part of risk that you're risking on this trade, you could potentially make 4.6%. Okay, chart patterns help the traders to set price target after a breakout. They give you a clear level of, to plan your entry and exits. And a good pattern should usually be well tested. Okay, from here, we want to take note right here. If let's say you are attempting to draw all these triangle patterns, you should only consider it a triangle pattern when you see at least the prices has touched either the upper line or the lower time for at least 5 times. At least 5 times, okay? Because there could be a lot of just unsolid patterns. It could appear like a triangle pattern, but if you plot it too prematurely, it may not even be that pattern after all. Okay, so the more touch point you see, the stronger the pattern would be. So like this case, we see that the prices touch 1 time, 2 times, 3 times, 4 times, 5 times, 6 times, 7 times. Yes, it's more than 5 times. Okay, and this is a good time to pay attention to the price movements and potentially set a pending order to get triggered whenever the prices breaks out from that pattern. And also, it is very important for us to take note that chart patterns are typically more reliable on a higher time frame. Okay, on a 1 hour time frame and above. Okay, a lot of people who are just starting out to trade, right, they would tend to go to 1 minute time frame, 5 minute time frame, and 15-minute time frame. Those are what we call intraday trading or scalping. In short, in the shorter time frame, right, anything below 15 minutes, the prices are largely random. Like it's very hard to trade in those low time frame, okay, because in the short time frame, it is largely driven by a lot of algorithms. Like the big institutional, or rather the big banks, they'll be trading intraday using the very complex algorithm. Okay, but on a larger time frame, from 1 hour, 4 hour, on a daily time frame, this is a chance where us as retail traders, we stand a better chance at taking a trade and making money from the trade, because on a larger time frame, it is harder for the algorithm to manipulate the prices. Okay, so here's a recap. Western TAs and Japanese TAs, they are not mutually exclusive. In the next slide, I'm going to share with you things about Japanese candlesticks for those of you who have no idea on what this is at the moment. Okay, so if you look at your chart, right, if you launch a candlestick chart, there are basically just two types of colors. So let's say if it's a green color candle, it would mean that the prices has gone up. It's a bullish candlestick. And if it's red color, it is a bearish candlestick. And it can be dissected into different parts of the body. We have this is what we call the body, okay? And we have the upper wick and we have the lower wick. But how do we read this? Actually, how do we read this? Very simple. We first focus on the bullish candlestick, okay? As an example, let's say you are looking at the price chart on a daily time frame, okay? Each candlestick represents the price movement of one day, okay? In that one day, the prices open up down here, and then during the day, it went up as high as the top of the wick, and it went down as low as the bottom of the wick, and at the end, it closed at the top of the body. Okay, yeah? So within one candle, you are able to see the summary of the full day's price movement. The same is for the bearish candlestick, where the prices open at the top of the body. It ranged at high, it went up as high as the upper week. It went out as low as the lower week, and ultimately it ended at the bottom of the body. So as long as the close price is below the opening price, it was a bearish move. Prices has gone down from where it started with. Okay, there are many types of candlestick patterns. I'm pretty sure if you try to see online, you try to understand, there are a lot of candlestick patterns. But I won't be covering all of them because it will be non-exhaustive. Okay, that's a lot. But what I hope to share with you is two things: how you are able to gauge the strength of the price by looking at the candle. So first type is a full-bodied candle, whereby you see the body of the candle is the large part of the whole candle. Okay, so what this means is that the conviction in the direction that it is going is very strong. In a full green candle, it means that it is very bullish. Buyers are fully in control. Okay, it started at below and it ended all the way at the top, no hesitation. Okay, and on the other hand, on a full body red candle, you can see that the selling pressure is strong. Okay, it started at the top and came down all the way down without much retracement. On the other hand, when you see a candle that has a small body, this means that there's a level of indecision and lack of momentum. In short, prices may be consolidating at this moment. Okay, so some of the more common forms of short body candles are things like doji candle and spinning top candle. You can research them on your own time. Okay, and there's also another form of the short body candle that is a hammer and shooting star as well. So whenever you see things like a hammer, right, or you see things like a shooting star, this would tend to mean that a reversal may be coming soon. Okay, and same goes to the doji candles, like all the small body candles. That means, let's say after the price has moved in like big bodied candle for some time, whenever you start to see a series of small bodied candles, excuse me, it means that the prevailing trend, the prevailing momentum may have been losing some steam. Okay, and it may be bound for a reverse at such a time. Okay, so now this is the slide where we try to combine the different concepts that we shared earlier. Okay, so a recap. We first need to identify the trend, okay, which I've shared with you a few methods. Is it going on an uptrend or a downtrend? Either by drawing horizontal lines or by looking at the EMAs to give you a guide. Okay, and secondly, you would be looking at any continuation chart patterns. So let's say in an uptrend, you see a bull pennant, you see a symmetrical triangle within an uptrend. Okay, and this is a time where, okay, potentially is a setup for you to enter into long position. Okay, and lastly, just when you're about to place a trade, let's say the candle that is happening right now, it is a candle that has a very long bottom wick. That means it is showing maybe a strengthening buyer sentiment. Then it's a good chance for you to enter into a long trade. So here's an example. Okay, you would only want to place a trade when the stars align, when the signals align. When the signals align, that's when it gives you a high probability trade. So let's go through this scenario. Okay, you identify a key support level using a Western TA. So let's say I've managed to draw a horizontal line that prices were staying above for the longest time. Okay, whenever prices come down, it bounces up. Whenever prices come down, it bounces up. Okay, or when the price is above the 200-day EMA. Okay, and at this level, a bullish hammer candlestick forms. Okay, which is actually a bullish reversal candle. Okay, and at the same time, the RSI is about 30. So I didn't cover RSI in detail today, but generally when RSI is at 30, it means that it is oversold. It tends to bounce up to the upside. On the other hand, when the RSI is at 70, it means overbought, that it tends to reverse to the downside. Okay, so this is the interpretation of the scenario above. Okay, when the TA say that the price is above its support, it points of a potential reversal to the upside. And RSI being at 30, it also points at a potential bounce to the upside. And at the same time, you have a hammer candle that also shows that the bullish momentum is rejecting the lower prices. So you have three confirmation from three different signals that tells you there's a high chance that if you enter into a long trade, it will go up. Okay, so this is when you want to engage in a long trend. So here's an example. So we look at the EMA lines right here. We can see that prices have been steadily finding the support above these EMA lines. Okay, and notice at this point, this was a resistance. This was a resistance. And after it pierced through this resistance in this full body candle, once again, full body candle means there's a strong conviction in the bullish bias, strong conviction. After it goes up, you see that it's been finding support at its prior resistance. Okay, so the first signal here is the price is uptrend because it's above the EMAs. The second signal here is the prices is forming an ascending triangle pattern, okay, which is a bullish continuation pattern. Okay, the third signal that we are observing at this time is you notice that the wicks are very long here. That means the prices, let's say the prices open somewhere up here. Okay, the sellers did try to push it down, but eventually the buyers come back in to bring the price up. And you see all these despite the prices meeting such low, the buyers were able to bring up the prices and it closed above, quite high above the low of the session. Okay, so if we see a few successive candles like that with a long lower wick, we know that the bullish momentum is stronger than the bearish momentum. Okay, these are what we call the hammer candlesticks, by the way. And you see, once it breaks out from this symmetrical, or rather this ascending triangle pattern, once again, it displays a very strong bullish momentum with a full-bodied green candle. Okay, so you see, whenever it pierces through a resistance line and it shows a full-body candle, this shows that there's a strong conviction on where it wants to go. Okay, so the first time you see my mouse here, it pierced through this level in a big green candle, and second time it pierced through the resistance level of this triangle pattern in another big green candle. Okay, and the entry rule for an ascending triangle is you want to enter after the prices has breached above the top resistance line. Okay, and you can see here the prices did continue to go up. Okay, so what we try to do as a trader, we really just want to look at the big picture. On the daily time frame, is it on an uptrend? Is it above all the EMAs? If yes, fine, amazing. If you step down to the 4-hourly time frame, is it above all the EMAs? Yes, it's fine. It is above, amazing. And you can then step down to the 1-hourly time frame to look to see if there's any of such a consolidation pattern, a continuation pattern. Then you can potentially enter into a long trade upon the breakout in the direction of the overall trend. Okay, so I'm not going to explain more about this slide, but essentially what I'm trying to say here is that if the signals that I talked about just now, if they don't align, okay, if you're not seeing the confluence that you want, if you're not seeing the confirmation that you want, it's better to stay on the sidelines. Okay, in trading, patience is key. You need to be patient, and really, I think from my experience, being patient is one of the lesson that everyone, I think it's a lifelong lesson that all traders are learning. Okay, so when you don't see your signal, you simply just don't engage. Okay, so now, if let's say you are really looking to trade, but you don't have so much time to actually analyze all the markets, to look at all the indicator, to look for the confluence of all that stuff, it's okay. Okay, while it's good for you to learn on your own, okay, what we have here on the platform is actually a bunch of trade signals that are provided to you by professionals that tells you exactly where to buy, where to sell, and where to put your take profit, where to put your stop losses. So introducing Acuity Analysis IQ. Okay, this is another feature that you can use it on your Phillip MetaTrader 5 platform for free and only for our live accounts clients, only for clients. Okay, so what they comprise is actually they have trade signals by human technical analysts. Okay, so they have a team at Acuity providing us with these signals every day. And at the same time, there are also AI generated trade signals that gives you transparent trading strategies it gives you clear entry level, it gives you clear take profit level, it gives you clear stop loss level. Okay, having a stop loss level and having like all these three levels that I mentioned earlier is very important in trading. Okay, you need to know where you want to enter, where you should get out, and where you should take profit. Okay, and all these signals, they are actually crafted with a combination of different methodologies. It could be from TA, it could be from sentiment analysis, and it is also the input from the human analyst at Acuity. Okay, so right now let me show you, just let me jump to the MT5 platform. Okay, so once again, what I have here is a platform that I've already downloaded the analysis IQ, and you can actually find it under the expert advisors tab right here. Okay, I drag and drop this feature onto the platform. I click OK. This would normally just take a little while for it to load. Okay, right here. So each and every one of these, right, it is actually a trade signal. Okay, it gives you the exact entry point, it gives you the exact exit point, and it also writes down for you to tell you what is the rationale or what is the explanation behind this strategy that they are suggesting to you. Okay, so the good thing about this is that you are also able to track the historical performance of all of these trades. Okay, and to follow all these trade ideas, very simple. You just need to click one button, which is trade. Okay, at this moment, all the information has been input for you. Okay, the order type, the price, the stop loss, the take profit. At this point, all you have to decide is merely the volume. How much volume do you want to trade? And as a typical rule of thumb, on every trade that you place, you should not risk more than 1 to 2% of your entire portfolio. Okay, so after you're done, you just place a trade. So right now it's not allowed because I did not allow my algo trading. So if I restart this, right, after I've enabled the algo trading, after I click OK, the pending order would have been it would appear under your pending order tab. Okay, but in the interest of time, I'm not going to relaunch this to show you that, but just be aware that after you've allowed algo trading, you are able to place a trade from here directly with all the input here. And also, the pending orders would not stay forever. They would only be valid for a certain period of time within the expiration date. Okay, and what you're seeing here is also a demo access. Therefore, it is a restricted kind of access. You see many of these trade ideas like US 30, NASDAQ 100 CFD, CAC 40. These are all locked, okay, because it's only accessible for our live accounts, okay, but I can provide you with a sneak preview on how it looks like on a live account, whereby you are able to see all these trade signals on various kind of asset classes. Okay, so there's a human generated signals, which is you can filter by here. Okay, and there is also AI generated signals. Okay, so only a live account you can access this. So I think by now my colleague would have sent a link in the chat box for you to click on it. If you open a live account, then you'll be able to access this feature. If on a demo account, you are not able to access. And also this is a feature that we offer to our clients on our Phillip MetaTrader 5. So let's say if you're using MT5 by another broker, you wouldn't be able to access to this because only if you log into our live server, you can get all these trade signals. But that's not the end, guys. That's not the end. And at this point, you may be wondering, so how is the historical performance of all these trade signals? If I follow, will I make money? Are they historically profitable or not profitable? The good news is you are able to track, or rather you are able to filter all these signals based on performance. So let's say if I want to select the win rate of anything, let's say win rate from 0% to 100%, that's fine. But how do you know if a trade is profitable or not? Is by the profit factor. Let's say if the profit factor is above 1, that means the trade idea has been profitable. Okay, so I've selected here my profit factor. I want to only see those that give me a profit factor of more than 1. I click apply. Okay, so these are all the trade signals that has been profitable in the past. So let's say if I go into pound dollar, okay, so this is currently a trade idea that has been published by them, okay, just very recently, okay, and you can see right here the historical performance of all these trades. Okay, so of course, right here, every bar that you see is a performance for 1 month. Okay, you can see at certain month the profit factor was 4.17. There were a total of 8 trades, and there's a win rate of 62.5%. And there are a few months that it is in the negative. Okay, in the negative. So what this tool allows you is really to filter and choose the symbols that has the best historical performance. And I'm also able to filter down to the top performers, where I'm looking at only the top signals that this platform is providing to me. So what I'm seeing here is the Nikkei CFD index signals. Okay, it's been giving me a historical performance. So right now, yeah, this is a bit negative, but in terms of the profit factor, it is above 1. So let's say we look at another one, like FTSE 100. Okay, so this one we can see the profit factor is 1.56. Okay, and this is basically based on a simulated account. Let's say you start from a baseline of 100K, and over the past 10 trades, how have they been performing? Like, is it when you see a red dot, it's a losing trade. When you see a green dot, it's a winning trade. Okay, and you are able to filter all of that. So in this case of the UK 100 index CFD, we can see that the historical performance has been great. Okay, there are a lot of signals covering a lot of asset classes here, but of course not all of them are profitable. So you are able to filter and sort and only follow those that you would like to follow and those who are in line with your view. Okay, if all is good, you click a button and then the trade would be, the pending order would be set on your platform. Okay, and then right now, I think my colleague at the same time has also sent a link in the chat whereby we have a full 1 hour session just to explain to you how this tool work. Okay, for today, I don't have the luxury of time to cover in detail of all the amazing features that this tool has. But after this, we encourage you to find out more about this tool by clicking on the YouTube video in the comments box. But once again, to access this, you can simply open a live account. Then you can look at all these trade signals and you can play around with it either for your own inspiration for your trade ideas, or if you like to follow these trade ideas and let it trade for you, that works as well. Okay, so coming now, let me introduce you the platform that you are able to use to trade the markets. Okay, so what I've been sharing with you is the Phillip MetaTrader 5 platform, which is a zero commission trading platform on all asset classes, forex, precious metals, and CFDs, including share CFDs. Okay, and our spreads are actually very tight. So for those of you who are trading FX, okay, we understand that spreads is a huge factor in for you to decide the trading condition. Like if you want to choose a broker, you would want to choose a broker that offers you a very tight spread. And right here today, we are very proud to share with you that Phillip MetaTrader 5 by Phillip Nova, we offer very, very tight spreads for all the FX trades at zero commission. Okay, so you may be seeing some of the other platforms, they are advertising zero spreads, but those will come at a commission. Okay, so from what you see here, it is zero commission, and we have compared with some other platforms that are offering zero commission as well. And in those boxes that we've highlighted in green color, that means that it is the most competitive. Okay, and of all the major FX pairs and also the top cross pairs, our spreads are the most competitive. Okay, so let's just look at the pound dollar, the GBP USD. Our spreads is at 0.7. Okay, the lowest spread 0.7, and other platforms they are charging at least like 0.9. And on a pair like pound yen, which is a very popular cross pair that people trade, we are offering at 0.9 pips. Okay, while other platforms they are offering at a much wider spread from 1.7 onwards. Some even going up to 2.5. Okay, so what's a good reason to get started with Phillip MetaTrader 5? First of all, okay, the spreads are tight. That means your trading cost is low. Okay, and secondly, let's say for those of you who are interested to trade shares, right? Phillip MetaTrader 5 also has a share CFD, for you to trade at zero commission. Okay, then at this time you may be wondering, if you're charging zero commission, then your spreads must be very tight, or your spreads must be very wide. Okay, but here I've outlined the numbers for you. Despite us not charging market data fee, not charging commission, no minimum fee on your share CFD, the spread is very, very tight. Okay, so our average spread per trade is about 0.04%. Okay, and what that's mean in numbers term. So if you place, let's say, 10 trades on all of the top traded US shares, right, share CFD. So the second column here is notional value. Okay, let's just take an example of Netflix. Okay, if you trade 12K of notional value, the spread that you're paying is merely 3.44, as compared to the industry norm where they charge a minimum commission on all your share CFD trade. Okay, so if let's say you're trading on those kind of platform, then you would have to pay $10 outright. Okay, so let's say on a first example, the Micron tech, if you're trading such a small contract, small notional value, on Phillip MT5, you are only paying 0.64 in terms of spread. Okay, so that's a trading cost. But if you trade elsewhere, you would have to pay $10 already. Okay, so I think your share really have to move a lot for you to break even from that minimum commission. Okay, so if you use our platform, you can significantly reduce your trading cost. You don't have to worry, the price has to move a certain percentage for you to break even from a commission. Okay, you're just paying the spreads. And this way, you are able to engage in a lot of shorter term trades, in, out, without the limitation of the minimum commission eating into your profit. Okay, so I think that is some very important consideration when you're looking to trading in a platform. Okay, so besides MT5, we also have another in-house platform, which the chart is powered by TradingView, and this is the platform where you are able to trade stocks, ETF. So what I'm talking about is actually stocks and ETF, like you're investing in all this for long term. It's not like the CFD that I was talking about earlier. Okay, and within this same platform, you are able to trade all the asset classes that we have: FX, futures, CFDs, options, everything, all in one. And it is called the Phillip Nova 2.0 platform. Okay, so right here, what I'd like to invite you to do is to join Phillip Nova as a client if you are not already, okay, due to a few good reasons. First of all, by scanning this QR code and submitting a account opening application, and after your account is approved, you have your MT5 account, you are able to unlock the full suite of Acuity Analysis IQ trade ideas that I was showing you just now. Okay, you'll be free to play around with it, look at it every day, look at all the trade signals for your own trades, and you can follow them right away. Free, everything unlocked for you. But let's say if you're just holding on to a demo account, you wouldn't have that, and what you see is just just a tiny fraction of what the platform has to offer. And secondly, as someone who just starting out to trade FX, you want to start learning about technical analysis. We also have the tools that would be able to assist you in identifying key areas of support and resistance, like the Trading Central Analyst View that I was sharing earlier. Okay, so by a drag and drop onto the chart, you would have all the support and resistance line all laid out for you already. Okay, and you can then use those levels to set as your target for either your long trade or your short trade. Okay, so just by scanning the QR code here, open a live account, then you'll be able to access all that features. And thirdly, excuse me, Phillip MetaTrader 5 is a fully zero commission trading platform. Okay, on FX and CFDs, including share CFD. And by the way, most of the brokers in the market, they do charge commission for share CFD. Okay, they charge a minimum commission on share CFD, like what I shared earlier, and they also charge a market data fee for US share CFD. Okay, on MT5, you're very lucky. We don't charge any of those fees. And what you'll be incurring is merely the spread, which is very tight, around about 0.04% of the notional value, and also the overnight fee if you are trading, if you're carrying a position overnight. So the overnight fee is also very competitive. It's about 0.02% of the notional contract value if you carry over for one day. Okay, so all in all, very competitive trading conditions for you. And lastly, like also what I shared earlier, our spreads on all our major FX pairs and CFD prices are very tight. Okay, like what I shared earlier, all our major FX pairs, we rival all the platforms that are out there at zero commission. So you are ensured to receive the best trading conditions, best spreads on our Phillip MetaTrader 5. Okay, so just by scanning this QR code right here, you are able to join us as a client and take advantage of all of these good features that will help you in your trading. Okay. And also, we very importantly, in terms of your consideration to choose a broker, it is highly advisable to choose a broker that is regulated by Monetary Authority of Singapore, MAS. Okay, because as a regulated broker, we are safe. We are under the supervision of the MES, so we uphold to the highest standard of security for our clients' funds. So when clients trade with us, when clients park their funds with us, they can be rest assured that it is treated with utmost diligence and your funds are safe, in short. Okay, so it is unlike trading and parking your funds in an overseas broker that is regulated, far away from the shores of Singapore. There is a real risk of you not being able to withdraw your money overnight, and there's nowhere for you to go to in order to make a complaint. But here, Phillip Nova, we are stationed at Raffles City Tower at City Hall, near City Hall MRT station. And if you have any questions, we welcome you to join us, to speak to us personally at our Raffles City Tower office. Okay, and also to open an account. If you have SingPass, that is good news. That would speed up your account application by a lot. And within 15 minutes, you'll be able to submit an account opening application successfully. And within, I think if all is good, you're able to start trading in a few minutes, or rather in a couple of hours. But if there's a further review, then after it is approved by our backend, then you'll be able to start trading right away. Okay, thank you all so much for joining us today at Phillip Nova's Introduction to Technical Analysis webinar. My name is Junkit, and it's been a pleasure speaking to all of you. Thank you for all your attention. If you have any further questions, do feel free to leave in the comment box, and we'll get back to you on the following days. With all our answers to your questions. And otherwise, going down the road, you are also welcome to just write into Phillip Nova at our official email address regarding any questions you have on our trading products and platforms. We'll be happy to assist and answer you on those queries. Okay, so once again, thank you so much, and we look forward to supporting you as our client after you scan this QR code, and we'll speak to you at our next session. And right here, I want to wish you a very good night, okay, and an early happy weekend to you. And more importantly, I wish you a prosperous months of trading ahead. Okay, thank you so much. Bye bye.